All right, let's jump right in. We're going to do a deep dive today on a really critical change for every retirement professional out there, the brand new framework for handling missed required minimum distributions, or RMDs. You know, the Secure 2.0 Act has completely reshaped the penalty landscape, and understanding these changes isn't just a good idea, it's absolutely essential. So let's get started.
So let's kick things off with the biggest headline change, the penalty itself. For decades, a missed RMD meant a staggering 50% excise tax. It was brutal. Well, the Secure 2.0 Act slashed that default penalty down to 25%. But, the real game changer here is the new, lower 10% rate for people who act quickly to fix the mistake. This really signals a fundamental shift. We're moving from a purely punitive system to one that actively encourages correction.
To get a full grip on this new environment, we're going to break it all down into 6 key sections. First, we'll look at the penalty's statutory basis. That's IRC Section 4974. Then we'll cover how to actually calculate the shortfall. After that, we'll dive into the new mitigation paths, the nitty-gritty of Form 5329, how to seek a full waiver, and finally, we'll talk about the game-changing new Statute of Limitations. Okay, so let's start at the beginning with the foundation itself, Internal Revenue Code Section 4974. This is the specific piece of the tax code that gives the IRS the authority to assess these penalties on missed retirement distributions. Everything else we're going to talk about today builds right on top of this. The entire penalty system is built around this one core concept, excess accumulation. It sounds complicated, but it's really not. It's just the difference between the amount the law required a person to withdraw and what they actually took out. That shortfall amount, that's the exact number the penalty's based on. Simple as that. So getting into the specifics of the revised IRC Section 4974A, the new default penalty is now 25% of that shortfall. And here's a really crucial point you have to remember. The code is crystal clear that this tax is paid by the payee. That's the individual account holder. The paying custodian isn't on the hook for this. The compliance burden rests squarely on the taxpayer's shoulders. It's also really important to understand just how broad the scope is here. You see, IRC Section 4974C defines a qualified retirement plan very, very broadly. This isn't just about one or two types of accounts. We're talking about the whole shebang, 401ks, 403bs, and all the different forms of traditional IRAs, including SEPs and simples. So for all practical purposes, these rules are pretty much universal. Okay, now, before you can even think about mitigating the tax, you have to calculate that shortfall with absolute precision. Seriously, any error at this stage is just going to cascade through the whole process. Getting this number right from the get-go is paramount. So, the core of the calculation is pretty straightforward. You take the account's fair market value on December 31st of the preceding year, and you divide it by the life expectancy factor. Now, here's a critical detail. You use that prior year-end balance as is. You don't adjust it for any missed RMDs you might be in the middle of correcting from that year. You just take the number and run with it. You know, one of the biggest reasons for RMD failures is the constantly shifting required beginning date. I mean, look at this. Depending on when your client was born, their RMD age could be 70 and a half, 72, 73, or now even 75. This creates so much confusion, especially for folks who delay their first RMD until that April 1st deadline and then completely forget that a second one is due for that same year by December 31st. It's a classic trap. Now, for the second half of that formula, the life expectancy factor. And getting it right means you have to answer this fundamental question correctly for every single client. In IRS Publication 590B, there are really 3 main tables you need to know. The Uniform Lifetime Table is your default, the one you'll use most of the time. Then you've got the Joint and Last Survivor Table, which is a key planning tool because it results in a smaller RMD if the sole beneficiary is a spouse who's more than 10 years younger. And finally, the Single Life Expectancy Table is for beneficiaries. Using the wrong one, let's say a beneficiary uses the Uniform Table instead of the Single Life Table, that's going to cause an understated RMD and trigger this very penalty we're talking about. This brings us to the new mitigation framework itself. Secure 2.0 basically moved away from that old, harsh, all-or-nothing 50% penalty and brought in a tiered system that actually rewards taxpayers for being proactive and fixing their mistakes. So how does a client actually qualify for that much lower 10% rate? Well, the new IRC Section 4974E lays out 3 very specific requirements. First, they have to take a corrective distribution of the full shortfall amount. Second, they have to submit a Form 5329 that reflects the 10% tax. And third, and this is key, they have to complete both of those things within a specific time frame called the correction window. So, what exactly is this correction window? Well, it opens at the end of the year the RMD was missed. But the tricky part is when it closes. It closes on the earliest of 3 possible dates: the day the IRS mails a notice of deficiency, the day the IRS formally assesses the tax, or if neither of those happens first, the last day of the second year after the year the RMD was missed. So, for a missed RMD in 2023, that outside date is typically December 31st, 2025. All right, let's get into the practical side of things, the paperwork. Form 5329 is the mandatory vehicle for all of this. It's how you report the shortfall, how you pay the tax, and how you request a waiver. It's all done on this one form. Part 9 of the form is where all the action happens. Line 52, that's where you put the total RMD that was required. Line 53 is what was actually taken out, which of course could be 0. Now, line 54 is the most critical. Here, you'll calculate either the 25% or 10% tax. However, if you're seeking a full waiver, you don't put a tax amount. Instead, you enter the letters RC for reasonable cause and the amount of the shortfall. And if you do that, line 55, the tax due should be 0. Now listen up, because this is a major procedural trap you need to be aware of. The form is usually just filed with the 1040. But what if your client doesn't have a filing requirement? Well, in that case, the Form 5329 has to be filed all by itself. And here's the catch. A standalone Form 5329 cannot be e-filed. It has to be physically mailed in. That's a critical detail to know to make sure you get a timely filing. Of course, the best outcome for any client isn't a 10% penalty. It's a 0% penalty, right? That's where requesting a full waiver under IRC Section 4974D comes in. And it's all based on establishing what the IRS calls reasonable cause. This really gets to the heart of how the IRS thinks. Reasonable cause is a high bar to clear. A serious illness, a death in the family, or a verifiable documented error by the financial custodian, that might qualify. But what generally won't work? Just saying you didn't know the rules, making a simple mistake yourself, or not having the funds to pay the tax. And crucially, to even be considered for a waiver, you have to show that you're taking steps to remedy the shortfall by withdrawing that missed amount. And now for our final section. This one covers what might be the most impactful long-term change for practitioners and their clients. A complete overhaul of the statute of limitations for assessing this tax. This is a big one. Previously, the 3-year statute of limitations clock didn't even start ticking until a Form 5329 was filed. Well, think about it. Taxpayers who missed an RMD often didn't even know they needed to file a form, so the statute could remain open indefinitely, exposing them to audits for errors made decades ago. The new rule, under IRC Section 6501 Law 4, is a complete sea change. Filing the regular Form 1040 now starts that 3-year clock for the RMD Excise Tax, even if Form 5329 is never, ever filed. But, and this is a big but, this protection comes with some critical limitations. First, this new rule is IRA-specific. It does not apply to missed RMDs from 401ks or 403bs. For those plans, you still have to file Form 5329 to start the clock. Second, it's not retroactive. It only applies to tax years 2023 and forward. And third, don't confuse this with the excess contribution penalty under Section 4973. The statute of limitations there is still 6 years, not 3. So, to kind of sum it all up, the legislative landscape has clearly shifted. The new rules under Secure 2.0 are moving away from a system of just harsh penalties and creating a more structured, formalized, and definitely less punitive path. It's a path that encourages taxpayers to find and fix their RMD errors proactively. And this leaves practitioners with a really critical strategic question to ponder. Given how ambiguous waiver approvals can be and how clear the path to a 10% resolution is, does it now make more sense to advise clients to just pay that 10% safe harbor taxes in the correction window? Is that better than risking a waiver request getting denied and then facing the full 25% penalty? That is the new calculation every advisor has to make.